2569, 2570 at this stage. Alok Agarwal is head of Quant and Fund Manager at Alchemy Capital Management. Alok, good to have you back on the program. Thanks very much for joining us. We had a nice move up. Now we got a bit of a downdrift, basically. So the range still stays and still awaiting triggers one way or the other for the market to do something different. And then, of course, you've got the rupee as well, which is precariously close to 80, 89. I mean, at least yesterday it was. And unless and until we get a deal quickly, as some have said, perhaps more weakness afoot. We'll see if the RBI comes in heavy. But what's your sense, Alok? Is the lift, has the lift ended that the market got, or is there more?
Yeah, hi Prashant, good afternoon. Pleasure to be here. As you hit the nail on the head, one of the key triggers that this market is possibly looking forward to is this deal getting signed between India and US. So that could be a major game changer in terms of us moving out of this range that we are seeing over the last few months. Nevertheless, a lot of steps have been taken both by the government as well as the RBI to ensure that a lot of demand push can be done. Over the last 10 months, we have actually seen the RBI doing a lot of stuff in terms of cutting the rates, cutting CRR, moving from deficit to surplus, and government too, like from a direct tax benefit of about 1 lakh crore to GST cuts. That was the most recent development. A small contribution also coming from the fact that those online gamings have been banned, so some more money possibly at the hand of the households. So demand push is definitely there. Government has been doing that part. But yes, if we can get that deal done, that could be a major victory in the near term. And that would be something that possibly could be the near-term trigger to push the markets further upwards. On the earnings front also, although we are seeing that the earning cuts in terms of estimates was there in the past few quarters, but the pace also has come down. So a lot of things are in place. But yes, that one deal is something that we are waiting for.
All right, hi Alok, good to see you. And that's going to be clearly the sentiment driver, right? Because we're doing as much as possible internally, but the big sentiment driver is going to be a India-US trade deal. But how would you approach the markets? Given that we know the deal is going to come about, it could take a month, 2 months, or maybe 3 months. But would you, look into buying all this weakness that we're seeing in the face of consolidation? Because as you said, we could probably get an RBI rate cut. The benefits of all the measures that have been taken by the central government as well will flow in the second half of the year. So how do you approach the markets from here on? You can't wait for that deal. I guess you'll have to start going in, right?
Yeah, and one has to err on the side of optimism here. So the most benefits, as you really pointed out, the most of these benefits will actually be seen in the second half of this financial year. There is case for possibly RBI for the rate cuts to come in as well. And the government is quite supportive. So that part is definitely there. And the earnings growth numbers have started coming in. Even if you look at the last quarter's numbers, the Nifty 500 earnings growth was at 10%, which in itself may not be a big number, but it is the best number we had in the last 5 quarters. The pace of earnings growth estimates cuts that has come down significantly. So we do expect that we are possibly around that turning around point wherein it's definitely more logical to be erring on the side of optimism rather than being too cautious.
So you're fully invested, Alok? And what have you all been incrementally buying as money flows in?
So structurally and the near-term basis as well, consumer discretionary broader basket is something that we are more positive on. So that traditionally consumer discretionary has included the likes of auto, retail, consumer durables, etc. But there are certain other aspects also that possibly has shades of consumer discretionary, may not be classified directly there. The likes of electronic manufacturing has shades of consumer discretionary. I would actually go ahead and say that savings is also like buying of consumer discretionary services. So the capital market plays comes in there, the premium real estate comes in there, even the private hospitals and travel comes in there. So a lot of those segments, and then the platform-oriented companies catering to the distribution of these. So there's a whole gamut of such companies which are catering to the rising disposable income as well as rising per capita income and the K-shaped recovery as well. So that's one area that we are more positive on. But we do also expect that this is not something that the government is trying to run the economy on one leg. Apart from consumption, the investment side is also on. And within the investment side or the capex side, the defense and power are the two major areas that we are positive on.
Defense and power. Alok, got that. So yeah, I mean, what you're saying completely makes sense that maybe it's not a good idea to totally look away from CapEx or the industrial part of the market as well. But how do you find valuations? I mean, defense stocks, they have paused and they're still off many of them are still off the 52-week highs. But are they providing a good entry point? And if that, in that sense, I mean, more on the shipbuilding side or a wide conglomerate like an L&T, how are you looking to play defense?
In case of defense, I think we need to possibly zoom out a bit to look at the broader picture. And the way the defense is, we need to possibly look at the global picture first. Broadly speaking, the global GDP stands somewhere around $100 trillion. Globally, 2.5% of GDP is spent on defense. That brings us to the number of about $2.5 trillion. Even if we take about 3-4% growth in GDP, but going by the pace at which higher defense allocation is happening, it wouldn't be surprising to hit a 5-6% of GDP as the number in possibly 5-6 years. So this $2.5 trillion expenditure over the 5-7 years has the potential to possibly reach $7.5 trillion. So that's a kind of number possibly could be there in the coming years. And it's coming at a time when India has started and decided to move away from being completely import dependent to be more independent by producing in-house and also in some areas trying to export as well. So that's a much larger area. That's why it's nicer possibly to take it as a comparison to the auto sector that was there in the 90s. So initially it is the major OEMs that do very, very well. But as the ecosystem does well, expands, you'll have far more ancillaries coming in. So that's where this sector may look expensive in near-term earnings, but this cuts, this falls, there's this kind of negative returns that comes in the shorter periods. These are the times that makes us far more positive.
Thank you, Alok, for joining in. We need the positivity because markets are slipping now. It's 20.